Imagine waking up one morning and seeing that your bank account received money while you were sleeping. No overtime, no second job, no extra hours. Just income generated by your investments. At first, it sounds too good to be true. Many people believe passive income is only for millionaires or people who started investing decades ago. But what if you had $30,000 to invest today? Could that money generate a reliable stream of income? Could it help pay your monthly bills? And if you stayed patient, could it eventually grow into something much bigger? In this video, we're going to answer those questions step by step. We'll build a realistic dividend portfolio using well-established companies with long histories of rewarding shareholders. Instead of chasing risky investments or trying to predict the next hot stock, we'll focus on businesses that have consistently generated profits over time. You'll learn how dividend investing works, why long-term investors rely on this strategy, and how simply reinvesting your dividends can increase your future income year after year. This isn't about getting rich overnight. It's about building wealth slowly, consistently, and with a clear plan. Think about it this way. Every single day, some of the world's biggest companies sell millions of products and services. People buy groceries. They purchase medicine. They pay utility bills. They shop online. As these businesses continue making profits, many of them return part of those profits to shareholders through dividend payments. That means your money isn't sitting idle inside a savings account. Instead, it's working inside real businesses that continue earning money every single day. Over time, those dividend payments can be reinvested to buy additional shares. Those new shares can then produce even more dividends. That's how compounding gradually builds momentum. The first few years may not seem exciting, but as your investment grows, each dividend payment has the potential to create even larger future payments. Of course, investing always involves risk. Stock prices can rise or fall. Dividend payments may change, and future returns are never guaranteed. That's why experienced investors focus on quality companies, diversification, patience, and long-term thinking instead of chasing quick profits. Throughout this video, we'll build this portfolio from the ground up. You'll see why each investment is selected, how different sectors work together, how dividend income can arrive throughout the year, and how a disciplined strategy may help build both growing income and long-term wealth. By the end of this video, you'll understand not only how dividend investing works, but also why millions of investors continue using this strategy as part of their long-term financial journey. Now, let's build the portfolio step by step and see what a $30,000 dividend portfolio could look like over the years. Now that Jake understands how passive income works, he faces the next important question. Where should he invest his money to build reliable income for the future? The stock market offers thousands of companies, but Jake quickly realizes that buying random stocks is not a strategy. Instead of chasing the hottest trend or hoping to get rich overnight, he decides to focus on businesses that have already proven themselves over many years. His first priority is stability. He looks for companies with long histories of earning consistent profits and rewarding shareholders with regular dividend payments. These are businesses that continue selling products and services whether the economy is growing fast or slowing down. But Jake also understands another important lesson. No matter how great a company looks today, putting all of his money into a single investment creates unnecessary risk. If one company struggles, his entire income could be affected. That's why he builds a diversified portfolio. Some companies produce everyday household products. Others operate in healthcare, utilities, real estate, banking, and consumer goods. Every sector performs differently, helping balance the portfolio during different market conditions. Diversification doesn't guarantee higher returns. It helps reduce risk while giving your investments a stronger foundation for long-term growth. Jake also studies something called the dividend payout ratio. This number shows how much of a company's profits are being paid to shareholders. If the payout ratio is extremely high, the dividend may become difficult to maintain in the future. Companies with healthy earnings and sustainable payout ratios are often better choices for long-term investors. He also avoids making emotional decisions. Instead of buying when everyone is excited or selling during temporary market drops, Jake stays focused on his long-term plan. His goal isn't to predict tomorrow's biggest winner. His goal is to own high-quality businesses that continue generating profits year after year. Every dividend payment he receives is automatically reinvested. Those new shares begin producing their own dividends, creating another layer of compound growth. Little by little, the portfolio becomes larger, stronger, and more valuable without requiring constant attention. Jake isn't trying to become wealthy overnight. He's building a financial system designed to grow for decades. And in the next section, we'll see exactly how he divides his money and builds a simple dividend portfolio that is designed to generate reliable passive income over the long term. Now that Jake's portfolio is fully built, one important question remains. How much money can it actually generate every month? This is where many people begin to think differently about investing. A dividend portfolio doesn't usually pay the exact same amount every single month. Some companies distribute dividends every month, while many others pay every quarter. That's completely normal, and it's exactly how many successful dividend investors build long-term passive income. Instead of expecting one large monthly payment, experienced investors focus on the total income their portfolio produces over an entire year. Imagine opening your investment account and seeing dividend payments arrive again and again without selling a single share. Some months the payments are smaller, some months they're much larger, but together they create a reliable stream of income that keeps coming back. That's one of the biggest advantages of diversification. When your portfolio contains companies from different industries and different payment schedules, your income becomes much more balanced throughout the year. Some businesses continue paying dividends during economic slowdowns. Others increase their dividends year after year as their profits grow. This combination creates stability while also allowing your income to increase over time. But the real magic happens when you decide not to spend those dividends immediately. Instead, every payment is automatically reinvested. Those dividends purchase additional shares. Those new shares begin generating their own dividends. Then those dividends purchase even more shares. Year after year, this cycle continues repeating itself. This is the true power of compound growth. At first, the progress feels slow. Your portfolio grows little by little. Your monthly income increases gradually. But after many years, the growth begins accelerating much faster than most people expect. Eventually, the dividends earned by your investments become larger than the dividends you received during your early years. Your portfolio starts working harder than ever while you simply remain patient. That's why long-term investors don't panic over short-term market headlines. They stay focused on building assets that continue producing income year after year. The goal has never been to become rich overnight. The goal is to build an income stream that becomes stronger every single year, because every dividend received, every share reinvested, and every year you remain consistent brings you one step closer to true financial freedom. Small dividend payments today can eventually grow into an income that changes your entire financial future. At this point, the numbers begin telling a very different story. In the beginning, the dividend payments may not seem impressive. A few $100s each month probably won't change your life overnight. But that's never been the real purpose of long-term investing. The goal isn't fast money. The goal is lasting wealth. Imagine looking at your portfolio 10 years from now. Instead of seeing only your original investment, you now see years of market growth, dividend reinvestment, and compound growth working together. Your portfolio has become larger. Your dividend income has increased. And most importantly, your money is producing even more money without requiring your attention every day. Now imagine another 10 years passing. The companies you invested in continue growing their businesses. Many increase their dividend payments. Your reinvested dividends continue purchasing additional shares automatically. Those new shares begin generating their own dividends. Then those dividends purchase even more shares. The cycle repeats itself year after year. This is why patient investors often experience their biggest gains during the later years rather than the beginning. Compounding starts slowly, but over time, it becomes more powerful. The longer you stay invested, the harder your portfolio begins working for you. Eventually, your investments may produce enough income to help cover real-life expenses. Maybe they pay your utility bills. Maybe they cover groceries or insurance. Some investors even use that growing income to fund vacations, education, or part of their retirement lifestyle. And for those who remain disciplined for decades, that income can eventually replace a full-time paycheck. That's why experienced investors spend less time worrying about today's market headlines and more time thinking about where their portfolio could be 10, 20, or even 30 years into the future. They understand that wealth isn't built by making one perfect investment. It's built by making smart decisions consistently and giving those decisions enough time to grow. There will always be market ups and downs, but staying invested through those moments is often what allows compounding to deliver its greatest results. Every dividend you receive, every share you reinvest, every year you remain patient, brings you one step closer to financial independence. Success isn't about predicting tomorrow's stock price. It's about staying invested, remaining disciplined, and allowing time to work in your favor. That's the lesson Jake finally discovered. His greatest investment wasn't simply the money he invested. It was the patience to let compounding transform his financial future. And that's how a simple investment strategy can become something truly life-changing over time. After seeing how powerful long-term investing can become, Jake realized something important. Building wealth wasn't about finding a secret stock. It wasn't about predicting the next market crash, and it definitely wasn't about checking stock prices every single day. The real advantage came from having a simple plan and following it consistently. Many beginners believe they need perfect timing before they invest. They wait for the market to fall, then they wait for even lower prices. Eventually, they spend years waiting while their money sits on the sidelines doing nothing. Jake decided to take a different approach. Instead of trying to predict the perfect moment, he focused on investing regularly. Whether the market moved up or moved down, he continued adding to his portfolio. When prices dropped, his money bought more shares. When prices increased, the value of his existing investments grew. Either way, he kept moving forward. This simple habit removed emotion from the process. He no longer worried about daily market headlines. Instead, he concentrated on what he could actually control: saving consistently, investing consistently, and remaining patient. Over time, those small monthly investments became thousands of dollars. Those thousands continued growing through dividends and market appreciation. Then something interesting happened. The portfolio itself started doing most of the work. Every dividend payment purchased additional shares. Those shares generated even more dividends. The cycle continued repeating year after year with very little effort. That's why many successful investors say that consistency is more valuable than perfection. You don't need to invest a huge amount on day one. You don't need to know exactly what the market will do next week. You simply need a strategy you can follow for many years. Because wealth is rarely built through one big decision. It's built through hundreds of small, disciplined decisions made over a long period of time. Jake finally understood that financial freedom isn't created by luck. It's created by patience, consistency, and allowing time to work quietly in the background while your investments continue growing year after year. After following Jake's journey from his first investment to a growing dividend portfolio, one final question remains. What lesson can every investor take away from this story? The answer isn't a specific stock. It isn't a secret strategy. And it isn't a promise of guaranteed returns. The biggest lesson is understanding that building wealth is a process, not an event. Every successful portfolio starts with a single decision: the decision to begin. Jake didn't become financially stronger because he predicted every market move. He became stronger because he stayed consistent through every market cycle. When prices were rising, he continued investing. When prices were falling, he continued investing. When the news created fear, he stayed focused on his long-term plan instead of short-term emotions. Over time, those simple decisions created something powerful. His portfolio continued growing. His dividend income continued increasing. And each year, his investments worked a little harder on his behalf. Many people spend years searching for the perfect investment opportunity, but they often overlook something far more valuable: time. Time allows businesses to grow. Time allows dividends to compound. Time allows patience to become one of your greatest financial advantages. That's why starting earlier is often more important than starting with a larger amount. Even small investments, made consistently over many years, can grow into something much bigger than most people imagine. Of course, every investment carries risk. Markets will always rise and fall. Dividend payments can change, and no strategy can guarantee future results. That's why successful investors continue learning, stay diversified, and invest according to their own financial goals and risk tolerance. Jake's story isn't really about earning passive income. It's about building better financial habits, saving regularly, investing consistently, thinking long-term, and allowing discipline to replace emotion. Because financial freedom isn't built in a single year. It's built through thousands of small decisions repeated over decades. The sooner you understand that, the sooner your money can begin working for you. And one day, you may discover that the greatest return on your investment wasn't just the money you earned. It was the freedom you created for your future.